So hello guys, I hope so you are good. So today we are going to discuss about what? Recognition of revenue over time. So first I'm going to explain, as we discussed in the last week actually. We discussed last week about revenue recognition at point in time. Actually, it is about IFRS 15, you can say in IFRS terms. So like its name is revenue from contract with customers. In last class, we discussed about 5-step process in which we discussed like to recognize the revenue. There are 5-step process which we need to follow. Step number 1 was we have to identify the contract with the customer. Step number 2, we have to identify the performance obligation. Step number 3 was we need to determine the transaction price. Step number 4 was we need to allocate the transaction price to each performance obligation. And step number 5 was we can recognize the revenue when or as performance obligation is satisfied. So that is not the story today. Today we are going to discuss about revenue recognition over time. So what it means, so let me just give you example. Even if it is your first class, you will understand what the topic is. Revenue means sales. So we are going to talk about sales, like when to recognize the sale in our income statement. So initially I will talk about only income statement presentation. You know, when we prepare income statement, we have to write their sales. From there, we have to deduct what cost of goods sold, and then this is how we get the gross profit. So today our focus area so far is income statement presentation, like how much sales we will book, how much cost of sold we will book, and how much gross profit we will book. This is what we are going to talk about, and this is called income statement presentation. So now let's start the topic. So we have a revenue recognition over time. So what does mean by over time, guys? For example, if you are a construction company and you got a contract to construct a road or to construct a building, for example, which will take 3 to 4 years, right? And you have agreed the price with the seller. With the customer, you have agreed the price with the customer. Maybe price, let's assume, is 10 million, right? But this 10 million, we cannot book the revenue in 1 year only, because the project life is 3 to 4 years. Every year you will prepare the financial statements, right? So at the end of each year, we are going to learn here how much revenue out of 10 million we can book in our financial statements. So this is what is called recognition of revenue over time, because you are going to book revenue in every year. You cannot book the revenue only in 1 year, right? And this concept is applies on what? Especially on long-term construction contracts. Understood? So guys, here we have almost 3 methods I will teach you, okay, to recognize the revenue. And with the passage of time, I will add methods into this. So first method which we will use, that is called input method. Which method? Input method to recognize the revenue over a period of time. Second method which we have to study, that is called which method? Output method. Okay, output method. So actually the third method is also called zero gross profit or gross margin method. So mainly these are the 3 methods which we will use to book the revenue, right? And first 2 methods, in first 2 methods, what we are going to do, actually we are going to calculate percentage of completion. What we are going to calculate? Percentage of completion. For example, if in the first year your project is completed, let's assume 30% only, so it means 30% revenue we will book. If in the next year, for example, if in the next year incremental percentage is 20%, it means we will book the revenue only up to 20%. So this all is the story. You will not get the story unless I will show you the workings or calculations, how it is going to work, right? So now I'm going to start first input method first. And then I will keep adding some additional points into this. Okay. So input method is what? As I told you guys, even you are dealing with input method or you are dealing with the output method. So actually you are going to calculate what? Percentage of completion. What you are going to calculate? Percentage of completion, like how much work has been completed in any given period. And according to that, you will book the revenue. So then what is the input method? Input method means to say you are going to calculate percentage of completion based on your inputs to the project. So inputs could be different things. Inputs could be what? Cost also, right? Maybe based on the cost, you will calculate the percentage of completion. And how you will calculate? You have to take cost incurred. Don't worry, I will show you the formula. I'm just explaining. Cost incurred divided by what? Total cost and multiply by what? Hundreds. I will get the percentage of completion. For example, total cost was 100 million. It will include estimated cost also. But cost incurred is only 20 million. So 20 over 100 will give you 20%. Understood? Same percentage of completion can be calculated based on other input also. Other input could be what? Labor hours. Maybe I have agreed a contract with you that I will work for you 100 hours or 1000 hours. Maybe in the first year I worked only 20 hours. So based on that, I can also calculate the percentage of completion. Like 20 hours divided by 100 hours. I'm just assuming. Same here, you can also calculate percentage of completion based on what? Machine hours also. Right? Maybe I have agreed with you that I will work for you 1000 machine hours, but in the first year I worked only 300 machine hours. So I can calculate the percentage of completion. 300 machine hours divided by 1000 machine hours. Right or wrong? It could be based on what? Time elapsed also. Maybe I have agreed with you that I will teach you for 2 years. Right or wrong? 2 years. Now in year 1, for example, I completed only first year. So if I want to complete the percentage of completion, I can take 1 year which is completed divided by total agreed years were 2. So I can again calculate the percentage of completion. So input method mean to say, guys, simply you are going to calculate the percentage of completion based on what? Inputs. Inputs could be cost, inputs could be hours, input could be time elapsed, inputs could be anything which you are injecting into the project. And don't worry how it is going to work. Now I'm going to start. So because in your exam questions, mostly the input will be calculated based on what? Based on cost. And that is why the input method is also called cost to cost method also. Because you are going to calculate percentage completion based on cost. Right? So you don't need to forget cost to cost method is also the part of input method, because we are going to calculate percentage of completion based on cost. And please guys, you have to remember this. As I told you, it is called what? Cost to cost method also. Please remember, whenever you apply the formula how you will apply, obviously I will explain step by step, right? And each steps you need to memorize with understanding. So for example, when you calculate here, when you write here cost incurred means the actual cost, and divided by what? Total cost, which will include actual also and estimated also, and you multiply what? 100. Please make sure in your cost, these costs must not be included. If in the question he told you these costs, so you should exclude. Don't make the part of cost. Which cost? So there are 3, I'm going to tell you cost. Number 1, the cost incurred that relate to what? Word is significant inefficiency. What is significant inefficiency? It means like wastage, abnormal wastage. For example, maybe I was constructing a project. I have completed half of the bridge, but suddenly this bridge is demolished due to any reason. Right or wrong? So it means now it is abnormal loss for me. It is what? Abnormal inefficiencies, right? So the cost of abnormal loss, he will use the word, the cost of abnormal loss is 20,000, right? So you should not include in the calculation. Right or wrong? Then we have second is what? You also need not to include what? General and administration cost. The reason general and administration cost, like for example, you are a company, you are running 5 projects at a time, and general cost is what? Maybe you have one accounts department. This accounts department is not created due to one project. This accounts department is taking care of all projects. So I cannot assign the cost of accounts department to any one project. So that is why general and administration cost will also be ignored. Okay, if it is given with the name of significant inefficiencies, why we ignore significant inefficiencies? Because it is not your routine loss, it is your non-routine loss, and I can't do non-routine loss. I'm charging to certain projects and I'm not charging to certain projects. And general administration, why I'm ignoring? Because it is not relevant to one project for which we are calculating the cost. And then selling and marketing cost, because when you include marketing and selling cost, you are not advertising one specific project. We assume here this selling and marketing cost for your entire company, for all projects, not for one specific project. So based on this ground, we will not include these costs into the percentage of completion. So which three costs I told you? Significant inefficiencies. What is the alternative name for significant inefficiencies? Abnormal loss. General and administration cost, selling and marketing cost. Apart from that, for example, if you are constructing a project, right? Constructing a bridge, you are incurring material cost, you should include. Incurring a labor cost, you should include, right? Incurring other costs due to that project, you should include, right? So this is what it was, just idea. Now I'm going to tell you, okay, how the percentage of completion or input method is going to work. So we are starting with what? Cost to which method? Cost to cost method. You can see it is also which method? Input. And what we are going to calculate? Percentage of completion. And now the steps I'm going to explain. This is the most integral part of this lecture. And I can guarantee you 2 to 3 MCQs or 2 to 3 questions in your exam from this topic, right? So please focus with me now. So here we go. So I will teach you input method from 2 different angles. From 2 different angles. And then I will tell you in which scenario you will apply first way or alternative way. So first I'm telling you first way of input method. So I hope so you are with me now. So step number 1 is what? Please remember, if your project is having life of 3 years, every year you have to repeat these 3 steps. In year 1, you will also do step number 1, step number 2, and step number 3. In year 2, you will also do step number 1, step number 2, and step number 3. In year 3, you will also repeat step number 1, step number 2, and step number 3. That is why in heading it's written what? Steps in each year. Okay? So here we go. I'm going to explain here. Guys, first step number 1 is what? You have to calculate what? Total cost. And I want to tell you how you will calculate the total cost here with that small example also. And for example, I'm assuming here your project is having 3 years life. Year 1, year 2, year 3. So 3 years project life is there. Okay, and he will tell you data in the exam question like that. He will tell you actual cost incurred in each year. And then he will put it here, another word which is called what? Estimated cost for remaining years. For remaining years. So these 2 rows. For example, in year 1, actual cost incurred is what? 100. Right? And we were estimating that the cost for remaining years means what? Year 2 and 3. Actual cost incurred in year 1 is 100, but cost which you will incur in year 2 and 3, which you are estimating at the end of the first year, you are estimating it will be how many $? $300. And in year 2, what happened? In year 2, actual cost you incurred 200, and you are estimating remaining cost will be how much? $100. I'm just placing the value. And in year 3, your actual cost is how much? 100. And remaining cost is what? 0. Why? Because my project will be completed. For example, this is the data given in the question. And I want to calculate what? I want to calculate step number 1, what as a total cost. I need your concentration and see how I'm choosing the data from the question to get the total cost. So guys, total cost will always be equal to number 1, what? You have to take the actual cost incurred till date. This phrase is important. I have to take actual cost incurred till date. If you're sitting in year 1, you have to see actual cost till year 1. If you're sitting in year 2, you have to take actual cost of year 1 and year 2 because that is till date. If you're sitting in year 3, you have to take actual cost till year 3. It means it will include year 1, year 2 and year 3. If you're not getting my point, let me explain for the first year how you will get it. Okay, so you have to take actual cost incurred till date and then you have to pick what you have to add. What you have to add? Estimated. Read with me. Estimated cost for remaining years. Estimated cost for remaining years. So let's do the calculation for year 1. I'm doing for what? Year 1. Let's see, I'm putting this calculation I'm doing for year 1. And step number 1 I'm dealing. Step number 1 is what? Total cost. What I have to take? I have to take actual cost till date. And I'm sitting in which year? Year 1. And this is my actual cost till date. How much? Is going to be 100. Plus, I have to add what? I have to add estimated cost for remaining years. So you are sitting at the end of first year, guys, and you have to go, you have to look what is the estimated cost for remaining year and you will pick this value. So this will be how much? 300. Total it will be how much? 400. Understood? Right? Now if you are doing for year 2, for year 2 again you have to do this way. You have to take actual cost incurred till date. Now you're sitting in year 2, guys. Don't forget year 2. So I have to take actual cost incurred till date. So I will take year 1 cost plus year 2 cost. It is going to be how much? 300 plus. And now I want to pick what? Estimated cost for remaining year. And in which year you are sitting now? Year 2. So you will pick this value only. Okay, you will add a plus 100. Again, my estimated cost is how much? Total cost is 400. Total cost would change. Even at the end of each year, estimated cost can also change. It is not necessary every time you will get 400. Now you will deal with the change. I will tell you, don't worry. Automatically, it will be dealt if you will follow this way. Now, if you want to calculate actual cost for year, if you want to calculate total cost for year 3, how I will do now, guys? I will take actual cost incurred till dates. It will include what? Year 1 plus year 2 plus year 3, which is going to be how much? 400 plus remaining cost is how much here? 0. It is total cost is going to be 400. Understood? This is how you will pick the data. So this was actually my actual cost first column. This was my remaining cost second column, and this is what equal to total cost. Understood? This is first step you have to do. Now guys, step number 2, need concentration. What do you have to do? You have to calculate what? Percentage of completion. Again in each year. Obviously, if you are sitting in year 2, so you need to calculate only percentage of completion for year 2. If you are sitting in year 1, you have to calculate percentage of completion of year 1. If you are sitting in year 3, you have to calculate percentage of completion for year 3. Right? And what is the formula? Can you see? What is the formula is written here for the percentage of completion? It is written actual cost incurred till date divided by, this is divided by what? Total cost and multiply by 100. This will give you percentage of completion. Can you tell me in first year how you will get percentage of completion? What is the actual cost is how much? 100 divided by what is total cost? 400. Multiply by 100, you will get 25% as the percentage completion, right? Now can you tell me how you will get the percentage completion for year 2? Actual cost is how much for year 2? Actual cost till date? 300. Right or wrong? Divided by what? Total cost is how much? 400. Multiply by 100, it will give you what? 75%. And in the last year, third year, you don't even need to calculate percentage of completion. The reason, we will assume project is completed and the percentage of completion will be 100%. Understood? What's the formula for percentage of completion? Can you read the formula? Actual cost incurred till date divided by total cost. And I told you how to get total cost in the step number 1. Right or wrong? And I also told you how to get actual cost incurred till date. Clear? Now step number 3. Step 3 and then we will apply. Don't worry. And see, step number 3 is what, guys? Step number 3. What we have to do? Please focus with me. Step number 3. He will ask you 3 questions actually in your exam. He can make 4 or 5 questions. But from step number 3, he will ask you to answer 3 questions. Number 1, he will ask you what is the amount of revenue should be recorded in the year, in any specific year. Second question, he will ask you what amount of cost of goods sold should be recorded in any specific year. And third question, he will ask you what is the amount of gross profit will be recorded in any given period. So how you will answer now? I need your concentration here. So first I'm going to talk about, income statement. We always write revenue, we always deduct cost of goods sold, and we will get what? Gross profit. So how you will calculate the revenue for that specific period? So you have to follow this format. Okay. So first of all, I have to calculate, I'm working for the revenue now. First, I have to calculate what cumulative revenue. Cumulative revenue means a total revenue till date. Total revenue till date. And from there, I will deduct revenue recognized in previous years. For example, total revenue till date is 500. And already I have recognized 300 in previous years. It means remaining 200 I will recognize in current year. Understood? So how it is going to work, don't worry. So let's start now. So first of all, I'm going to work with what? Cumulative revenue. Cumulative revenue, how it will be calculated? You need always which price? Contract price. What is contract price? Means a contract value. The price which you have agreed with the customer. Right or wrong? He will tell you, let's assume I'm telling you, I will construct your house for $1 million. So 1 million is the contract price which we agreed. My cost could be any, but I agreed value for 1 million. You have to pay me 1 million. Understood? Regardless of my cost, whatever it is, you have to pay 1 million. So I have to take contract price, multiply by what? Percentage of completion. For example, I'm assuming, for example, contract price is 1 million and percentage of completion is how much percentage? 50%. Assume you are sitting in year 2. Percentage completion could be, let's assume in my example, it was how much percentage? 75%. You will take 1 million times 75%. This will give you 750,000 as which revenue? Cumulative revenue. From there, this cumulative revenue mean to say, this includes the revenue of previous year also. From there, I will deduct what? I will deduct revenue recognized in previous years. He will tell you this value. For example, if you are doing calculation for year 2, he will tell you what was the revenue recognized in year 1. If you are doing calculation for year 3, he will tell you what was the revenue recognized in previous year 1 and year 2. You will deduct that, you will get what revenue for the year. For example, in previous year, I have already recorded the revenue of 500,000. It means how much revenue I will record in this year? 200,000. Understanding? Clear? You have to memorize these steps. If you will not memorize, you will not be able to solve questions. First, for revenue, what you got? For revenue, first, what you got? Cumulative revenue. I told you how to get it. Then from there, what you will do? You will deduct revenue recognized in previous year. Can I ask question? I'm saying that you are calculating revenue for the first year only. Or first year. So what you will do? You will take contract price, multiply by percentage of completion of year 1. This will give you what? Cumulative revenue. From there, you will deduct what? Revenue recognized in previous year. And there are no previous years relevant to this project. Previous year revenue will become 0. So you will get whole revenue for the year. Understood? Clear? Then what do you have to do, guys? after that, once you got the revenue for the year, now you have to deduct. What you have to deduct? Cost of goods sold, because cost relevant to that project I also need to reflect in my income statement. And we are talking about income statement presentation. I didn't say anything about balance sheet presentation. Balance sheet I will tell you at the end. Contract assets or contract liability. Understood? So here, same we will follow for the cost of goods sold. Look at here, for the cost of goods sold, same format we will take. First of all, we will take what? Cumulative cost of goods sold. And cumulative, what I will do? I need which cost? Total cost. It's not cost incurred till date. It is total cost. And I told you step number 1, how you will get total cost, right? You will pick that total cost and you will multiply what? With the percentage of completion. So this will give you cumulative cost of goods sold. Understood? And then you will deduct from there what? Cost of goods sold recognized in previous years, if any. Okay, so you will deduct that one. So you will automatically get what? Cost of goods sold for the year. Understood? So here you got revenue for the year. Here you got cost of goods sold for the year. If you will take revenue minus cost of goods sold, what it will give you? Gross profit. Understood? Now he can ask you many questions. For example, he's asking you, now you have to pick how you will answer the questions. He's asking you, what is the cumulative revenue? It means this is the answer. If he's asking what is the revenue for the year, it means now this is the answer. If he's asking what is cumulative cost of goods sold, this is the answer. If he's asking what is cost of goods sold for the year, this will be the answer. Right or wrong? If he's asking gross profit, then this will be the answer. Understood? Or maybe the question he will ask you only calculate the percentage of completion. It means step number 2 will give you the answer. So many questions you can ask you. So you need to open your mind and read the question carefully, what you are being asked. Understood? So 5, 6 questions I told you which are possible. They can ask you. Got it, guys? So now let's apply with the help of example. I'm going to show you little bit long examples. I will do the calculation for all 3 years. And in all 3 years, we will repeat all these 3 steps. Understood? So here we go. I need your concentration now. I would request you to go through this example. You have to read this example from here till here only. And we will be doing the calculation for all 3 years. In year 1, what you will do? Year 2, what you will do? In year 3, what you will do? Okay, please read it. You read it? So what they are telling you, they are saying that on January 1, year 1, contractor agrees to build on the customer's land a bridge that is expected to be completed at the end of year 3. It means it will take 3 years, right? You are starting at the start of year 1. It will be ended at the end of year 3. So year 1, 2, and 3 years are required. The promised bridge is a single performance obligation. It says you have to complete only one bridge to be satisfied over time, because it will take how many years? 3 years. That is why it will be satisfied over time. The contractor determines that progress toward completion of the bridge is reasonably measurable using which method? Input method you have to apply on cost incurred basis. It means cost you will use to calculate the percentage of completion. So the contract price, see, what is the contract price? Contract price is 2 million and expected total cost of the project is how much? 1.2 million. And then he told you data for year 1, year 2, and year 3. Here he told you cost incurred. Actually, it is actual cost. And here he told you cost expected in the future. It is cost for estimated cost for remaining years. Right? So I'm going to do year 1, 2, and 3 calculation. You will help me now. So what was step number 1? Year 1 we are doing. All calculation belongs to year 1. So you have to calculate first what? Total cost. It will take time because I have to solve 3 years and see how it is working. Total cost, how you will calculate, guys? You need actual cost till date, plus what? Estimated cost for remaining period, right? So what is it? In year 1, actual cost till date is how much? 300,000. And what is remaining cost? You will pick this much, 900,000. So total is going to be how much? 1.2 million, right? Now step 2 is what? You have to calculate percentage of completion. Right? Percentage completion, how you will get? You need actual cost till date, which is how much? $300,000. And divide by total cost, which is how much? Please open your calculator and help me with the calculation. Divide by 12, 1.2 million. So and multiply with the 100, you will get percentage completion is 25%. Understood? And now, guys, you have to do step number 3. What was step number 3? First, you have to do calculation for revenue. For revenue, what was the formula I told you? You have to calculate first. No, first cumulative revenue. Cumulative revenue, what was the formula? Contract price multiplied by percentage of completion. What is contract price? 2 million. 2 million. This is contract price. Multiply percent completion is how much? 25%. So this will give you how much? $500,000, right? Now you will deduct minus revenue recognized in which year? In previous year, 0. Because we are doing calculation for year 1. So it means the whole, the revenue for the period will be how much? Revenue for the year, I'm writing shortcut. It will be how much? $500,000. Right? Now you can calculate what? Cost of goods sold also. So I'm moving to the next slide. Right? So cost of goods sold, how you will calculate, guys? Cost of goods sold. I'm just writing. So you have to, this is CGS calculation, cost of goods sold. So first you have to calculate what? Cumulative cost of goods sold. For that, what was the formula? Total cost. And I have calculated total cost as 1.2 million into percentage of completion, which is 25%. So it will be how much? 300,000. Understood? Ignore my mathematical errors. If you will help me with the calculator, I will get correct. Otherwise, maybe I can get wrong. So from there, you will deduct what? Cost of goods sold for which year? For previous years, which is what? 0, because it is my first year. And now, guys, here you will get cost of goods sold for the year. CGS for the year, how much? 300,000. Tell me what will be your gross profit. So because revenue you have booked 500,000, cost of goods sold you have booked what? 300. So gross profit will be how much? 200,000. Understood? Now I want to do calculation for year 2, and I want you to just remember this information again for year 2. Your because you have to calculate total cost first. The total cost you need what? Actual cost incurred till date, which is how much? 900. And what is the estimated cost? See, so total will be 1.5 million now. It's changing, right? In the first year it was 1.2 million. Do you remember? Don't forget these values. This is what I'm going to use in year 2. I will not revert back to this example now. Okay? What is the actual cost in first year? 300. What is the actual cost in year 2? 600. And what is the estimated cost in year 2? 600. So this is what we are going to do. Year 2 calculation I'm going to do now, because I will not revert back to the example now. So guys, year 2. So let's do it here. Year 2 calculation we are doing. Please focus with me. Year 2. First of all, you have to calculate what? Total cost is equal to what? Actual cost till date plus estimated cost for remaining years. right? Actual cost till date is how much? In the first year you have incurred how much? 300. In second year you have incurred how much? 600. This is called actual cost till date, which is how much? 900,000 plus estimated cost is how much? 600,000. In year 2 it is given, right? The total is going to be how much? 1.5 million. First step is done. What is step number 2? Step 2 is what you have to calculate percentage of completion. And what was the formula? You have to take actual cost till date, which is 900,000, divide by total cost, which is how much? 1.5 million. Understanding? So multiply by 100. Can you tell me, sir? It will be, I guess, 60% if I'm not wrong. Please help me with the calculation, otherwise we might not get correct answer. 60%, great. So 2 steps are done. So step 3 I'm going to do here now. Need concentration. Need concentration. Guys, step 3 is what? You have to calculate first. First I have to do calculation for what? Revenue. For revenue you have 2 columns. What? Cumulative revenue minus revenue recognized in previous years. So cumulative revenue, how you will get? You remember contract price, which is how much? 2 million in the question. Multiply percentage completion, which is how much? 60%. It will give you cumulative revenue. 1.2 million, right? And now you have to deduct revenue recognized in previous year. In previous year, how much revenue we have recognized? Here it is calculated. 500,000. We will deduct. Understanding? We will deduct what? 500,000 from here. So how much revenue you will recognize in the current period? 700,000. This is the revenue for the year. Understood? So now you will work with what? With the cost of goods sold. Same way you will work CGS. You have to calculate first what? Cumulative CGS. For that you need total cost. And in year 2, you have calculated total cost. Up, somewhere up. Total cost was 1.5. This you will take. Right? So you will take total cost, which is 1.5 million. Total cost, which is 1.5 million. Into percent completion is how much? 60%. You will get 900,000 as a cumulative cost of goods sold. And you will deduct here cost of goods sold recognized in which year? Previous year. And previous year, if you remember the calculation, where it has gone. Maybe up. So we have booked 300,000 somewhere. Here we calculated, right? In year 1. So we'll deduct 300,000 from here. So how much cost of goods sold will be recognized in a year? This will be cost of goods sold, which for which year? For the year. So how much it is going to be? $600,000. What is your gross profit now? GP, because you have booked the revenue 700. Your cost of goods sold is how much? 600. So GP is going to be 100,000. Done. Do you want me to do for year 3? Yes, we can do. But again, I will take you to the data. First, you have to remember the data. Now, in year 3, I am doing now. For year 3, I have to take first actual cost till date. Actual cost till date will become how much? You have to add all. And remaining cost is what here? 0. Right or wrong? So can you add how many actual cost is there? 300 plus 600, 900 plus 550. 1450, right? 1.45 million. So this is what step 3 I'm going to do for year 3. Understanding, guys? So year 3 workings we are going to do now. Again, first calculate what? Which cost? Total cost, which is equal to what? Actual cost till date plus estimated cost for remaining period. Actual cost till date was 1,450,000. Estimated cost is 0. Total cost is going to be 1,450,000. Understood? And step number 2 is what? You have to calculate what? Percentage of completion. Can you tell me what is the formula? Actual cost till date, which is 450, I mean say 1.45 million, and total cost is also same. That is why I told you, you do not need to calculate percentage completion in the last year, because it will automatically be how much percentage? 100%. Even you applied the formula, you got 100%. Understood? Now you have to calculate what? Revenue. Guys, how you will, I'm not sure if you remember the values. Revenue, first of all, you have to write here revenue. I'm putting here revenue. So you have to write here what? Cumulative revenue. Cumulative revenue, how you will get? Contract price, which was how much? 2 million times what percentage? Cumulative revenue is how much? 2 million. Right? From there you will deduct what? Revenue recognized in which year? In previous year. I'm not sure if you remember the value, even I don't remember. Let's see. It was, look now. In first year you recognized how much? 500. In second year you recognized how much? 700. Total is recognized 1.2 million. Okay, here it is now. So revenue recognized in previous year is 1.2 million, because 500,000 was recognized in the first year, 700,000 is recognized in the second year, so 1.2 million is recognized. So you have to recognize remaining in the year, which will be 800. This is what revenue for the year. Right? Now you have to calculate what? You have to deduct what now? Cost of goods sold. For cost of goods sold, what was the equation? You have to calculate first cumulative cost of goods sold, which how you will get? Total cost. Total cost is how much? 1,450,000 in the current year, right? Times what? Percentage completion, which is how much? 100. So this will give you 1,450,000. From there you will deduct cost of goods sold recognized in which year? In previous year. I don't remember what was the value. I guess 300,000 recognized in the first year and 600,000 is recognized in the second year. This is what I believe these were the values. So total is how much you have recognized? 900,000. You can just cross check from the question. Okay. I'm not going back. If you want me to go back, I can check. This is the year 2 or 1. This is the year 2. This was the revenue. In year 2, cost of goods sold was 600. In the first year, it was 300. Total is 900,000. Okay. So you will deduct from here. So you will get 550,000, I believe, if you will deduct. This will be what? Cost of goods sold for which year? For year 3. Understood? And what is the amount of gross profit you will record now? Revenue you have booked how much? 800. And cost of goods sold you have booked 550. The remaining revenue will be, gross profit will be how much? 250, right? 1,000. Understood? So this is how the input method will work. I hope so you got the idea. You just need to practice this example. And now I'm going to show you some exam standard question answers. Okay, guys. So we have some notes, exam related notes. As I told you, few notes. In the last year only, for the last year, the personal completion will be what? 100%. You don't need to work. Don't waste your time in the exam. Understood? If you are required to do calculations for last year, the new personal completion is 100. Otherwise, you can follow the process. It's up to you. Second is what? In cost to cost method, which we are discussing now. Please remember, sometime in exam question, he will tell you actual cost He will tell you what? Actual cost, he will tell you which cost? Estimated cost, plus he will tell you amount billed to the customer and amount received from the customer. Please remember, you don't need to worry about the amount billed and received, just simply you have to ignore. You have to focus what? Actual cost and estimated cost, because this will give you total cost, not the amount billed and received by the customer. Understood? So you have to ignore this line, amount billed to or paid by customers. It should be what? Ignored for revenue and cost of goods sold calculation, not for contract asset and contract liability. For income statement presentation, you will ignore this, right? Understood? And also one more point. Do you remember in the first year, our total cost was 1.2 million. And in the second year, our total cost was 1.5 million. I did not adjust any previous year because it is what I'm trying to tell you, the changes in the cost, in the estimation. Because your cost is changing due to change in estimates. So we will always treat as changes in accounting estimate, and it will be applied prospectively from current year to onward. You are not required to adjust previous years. Understood? Clear? Practically, you should not forget this point. Now, guys, I want to show you one exam standard question. Maybe in your exam question will be like this. Okay, so I would request you just read this question from here till here. Actually, first read, please. Or let me read with you and let me explain the data, how data you will choose now. They're saying a consulting company won a 20.8 million three-year contract. Actually, this 20.8 million is your contract price. Okay. And project life is how many years? 3 years. And please also read the requirement. Always try to read the requirement first. You will be more specific then. They're telling you using cost to cost method, how much revenue should be recognized in first year. It's more easy because you do not have any revenue recognized in previous year. You do not have any cost of goods sold recognized in previous year. It's very simple now. So for the first year, you have to do the calculation, and the contract price is how much? 20.8 million. The contractor requires software development, hosting, and maintenance over 3 years. The total estimated cost of the project is 17 million. Total cost, he told you. Estimated. With 10 million expected in year 1, 5 million in year 2, 2 million in year 3. This is how he's estimating 17 million. Because he's thinking 10 million I have to incur in first year, 5 million in second year, 2 million in third year. This is totally his estimate. Then the billing schedule shows that 5 million will be billed. Billed, we don't need to worry. 5 million will be billed, okay, upon start of work, and then 5 million at the end of each year. You don't need to worry about billed and paid by customer. At the end of first year, this is important information. We need to know what is the actual cost. At the end of the first year, the actual cost incurred is how much? 9 million. Right? And he told you total estimated costs are what? This is also important information. It means he told you all, by the way, both things. He told you actual cost incurred till date because year 1 actual cost is given. Divided by, he also told you total cost because he told you total cost will not change. So directly I can calculate percentage of completion. Am I right? I don't need to do step number 1. In step number 1, total cost is required. That is already given. He told you it will not change. So based on this, you have to calculate now. So what I will do, I will calculate especially what? Percentage of completion directly for the first year. And for that, I need actual cost till date. Actual cost is how much? 9 million, I told you. And total cost is how much? 17 million. And multiply by 100. Please help me with the calculator. 50. Exact or rounded? 52.94%. This percentage of completion. Now you have to calculate only revenue. Revenue told you cumulative revenue. Cumulative revenue is always equal to contract price into what? Percentage of completion. This is what is your answer. The reason you are doing calculation for the first year, you do not have any revenue recognized in previous year. You don't need to deduct. The contract price was how much? 20.8 million. 20.8 million. Okay. Multiply by percent completion, how much? 52.9. If I want to write full values, okay, just write 20.8 million times 52.94%. It will give you value. How much? Please help. 11. Just calculate. 11. Okay, almost 11 million. So what is your correct answer? B option. Understood? We did the first example for all 3 years. In your exam question will be, most of the time will be like this, which you have calculated now. Simple, more simple. Understood? This was which method? Input method, cost to cost method. Now guys, I want to tell you here, input method is another way to do it. And I will tell you when to apply this method. For some time, please listen to what I'm saying. Sometime in exam, he will ask you to calculate gross profit what? For the year. This is what you have to calculate. And in exam, he will tell you GP recognized in which year? In previous year, he will tell you. In that scenario, I would suggest you, if this two information is given, he's asking what? Is what he's asking? Gross profit for the year. And he has given you what? Gross profit recognized in previous year. So then I would suggest you should follow this way, which is called alternative calculation to input method. Follow this way. Understood? If he's asking about revenue and cost of goods sold, I will suggest you use the first way. Even if he's asking revenue for the year, but he didn't tell you gross profit recognized in the previous year, again I would suggest you do the first way. But if he told you gross profit recognized in the previous year, GP recognized in the previous year, then I would suggest you follow this way, which I am solving. Okay? There's another way, guys. You have to be aware with both. And I told you conditions when this way you will apply. Okay? So how you will do it here? Here, 3 steps you will again do. Step number 1. You have to what? Estimate what? You have to estimate the gross profit for each year. For example, you are doing calculation for year 2 or for year 1. So you have to estimate first, estimate the GP value. How you will estimate? Simply you will follow this equation. You will put contract price. From there you will deduct what? Total cost. And I told you total cost how you will get. How you will get total cost? Actual cost till date plus estimated cost for remaining period. This will give you which cost? Total cost. Take contract price minus what? Total cost. This will give you what? Estimated amount of gross profit, estimated value, total gross profit. And then step number 2, what? You will calculate what? Percentage of completion. And for percentage completion, we always need what? Actual cost incurred till date divided by what? Total cost. And by the way, you have here these two information. Actual cost till date divided by total cost. Understood? Clear, guys? Once you will divide, you will get what? Percentage of completion. And now quickly you will move to the step number 3. What I am required to do? I am required to calculate gross profit to be recognized in each year or in any given period. So what I will do? I will calculate here first what? Cumulated GP. GP directly I will do because GP recognized in the previous year is given. Okay, so what I will do, I will take total gross profit which I have estimated in step number 1, multiply by percentage of completion which I have calculated in step number 2. Simply step number 1 multiply by step number 2. This will give you cumulated amount of GP. From there you will deduct what gross profit recognized in the previous year, which will be given in the question. So you will automatically, once you will deduct, you will get what gross profit recognized for the year. And I'm going to show you the question now. Even if you will try, whenever this information is given, this especially GP recognized in the previous year, if you will apply first way which I told you, so maybe it will not work. So you have to follow this way, which I told you just now. Understood? So now guys, here let's do how question will be tested. I would request, please read this example. So in this question, guys, what is provided? Half construction company has consistently used which method? Input method. And based on what? Cost incurred to measure progress toward completion of the project. On January 10, year 3, half began work. Actually, we have a year 3. Then we will have year 4 and we will have year 5. I'm not sure. Let's read what the data is given. So they're saying on January 1, year 3, half begin a work on 3 million construction contract. 3 million is the contract price actually. At the inception date, the estimated cost of construction was how much? 2.25 million. The following data related to the progress of the contract. So gross profit recognized in year 3. Year 3 actually is your first year. Because in year 3 you started the project. So it is going to be the first year of the project. Right? This is what he told you, GP recognized in year 3. It's given. It means gross profit previously recognized is given. Then cost incurred from 10th January, year 3 to December 31st, year 4. This is called cost incurred till date. Till date. Why till date? Because you have to do the calculation for year 4. It means he gave you cost of year 3 plus cost of year 4. This is called actual cost till date. Then we have here estimated cost to be completed at 31st December year 4. Actually, this is estimated cost for year 5 actually. Because you are estimating at the end of year 4. For future, it is estimated cost. And why, guys, what is the question? It means year 4 is going to be your second year of the project. What is the question? He is asking you in its income statement, the year end 31st December year 4. This is year 4, which is year 2 actually for your project. The amount of gross profit should be, what amount of gross profit should report? So how you will calculate, guys? I told you, simply you have to calculate first. You have to estimate the gross profit. How you will estimate the gross profit? Step number 1, you will take contract price, which is how much? 3 million given here, right? From there you will deduct what? Total cost. Total cost will include what? Actual cost till date, which is how much? 1.8 million, and plus what? Estimated cost. Estimated cost is how much? 6 million here is given, right? So it means total cost is going to be 2.4 million. So this is what is your GP value, right? GP value is how much? 600,000. Step number 1 is done. Now step number 2, what you have to calculate? Percentage of completion. How you will get, guys? You need actual cost till date, which is how much? 1.8 million divided by total. Total is how much? 2.4 million. You will divide the total 2.4 million and multiply by 100. Can you tell me what is the GP or what is the percentage completion? It will be 75%. Understood? And now you have to calculate what? Gross profit for year 4. So first you will calculate what? Cumulative GP. Cumulative GP I told you, step number 1 multiply by step number 2. So for step number 1, total GP is how much? 600, and percent completion is how much? 75%. You will get how much? You will get 450,000. You will deduct from there what? GP recognized in previous year. In which year? In previous year, he told you how much? 300,000 is already recognized. It means how much you will record in year 4? 150,000. This will be the GP for the year. 150 should be the answer. Understood? So please, it requires only practice, guys. So which is correct option? B. Understood? Now, guys, I hope so. This was all about which method? Input method, cost to cost method. Now, we have one more question here. Let's do it. This question also. They're telling you a company used which method? Input method based on cost incurred to measure the progress towards completion. Actually, the percentage of completion is calculated based on cost of 4-year construction contract. Which of the following items should be used to calculate gross profit recognized in the second year? Tell me, gross profit previously recognized you will use or not? Yes, we are using. It's relevant. What else? Amounts billed to customers? No. So where is the answer? It means then there should be D, because gross profit previously recognized is relevant, but amount billed to customer we don't need to focus here for the income statement presentation. It means option D should be correct option. Now, guys, there is the one more point. Again, it is input method. Which method? Input method. But sometimes revenue can be recognized based on what? You don't need to calculate percentage of completion. Simply on straight line basis, you can record the revenue. For example, I'm just giving example. First, have a look what it's written here. It's written. This is the important point to solve critical questions. It means there is a third option. For example, my contract price is 50 million. 50 million is the contract price, and this contract is for 5 years. Every year, how much revenue I can book? 10 million, 10 million. This is called straight line. But when we can do this, when we can book 10, 10, 10 in every year. So this is the condition. When an entity's inputs are incurred what? Evenly over time. Like every year, you are incurring same cost and incurred evenly over time period. Then they are saying standard is saying you may use which method? Straight line method also. So here is the key point is what? When inputs are incurred evenly throughout the period. Okay, so you can book the revenue equal amount in every year. Simply take contract price, divide with the number of years, you will get one amount. That amount can be booked every year. But what is the condition for that? Inputs are incurred evenly over time. Understood? Clear? There will not be any calculation for this. What calculation he will give you? Nothing. So contract price will be given. Divide with the number of years, you would get yearly revenue. But from the question, you need to look this word. Inputs are incurred evenly over the year or not? If yes, then you can book the revenue based on straight line method. Understood? This question you need to look from the question first. This word, you have to look from the question. Understood? That's great. Now, guys, we are going to talk about what? Output method. Under output method, actually, again, we are going to calculate what? Percentage of completion. Here, just your way of thinking is different. Previously, we were calculating percentage of completion based on what? Inputs. Now we are going to calculate percentage of completion based on output. For example, I'm giving you example. Let's assume I have agreed with you that I will produce, let's assume 10 units for you. How many units? 10 units. And now in the first year, I have produced only how many units? 3 units. I can calculate the percentage of completion based on output, right? How I will get the percentage of completion? I will take 3 over 10 multiplied by 100. It means 30% work is done. It means I can book the revenue up to 30%. Maybe, for example, I'm saying that I will construct 3 houses for you. In the first year, total houses are 3. In the first year, 1 house is completed and it is handed over to the customer also. It means how much is the percentage of completion based on my output? 1 over 3 times 100. I can say 33.33% work is completed. This is what is called which method? Output method. And because here, what's the difference? Only the difference is you have to calculate percentage of completion based on what? Output, not based on input. And step 3 will not change. Step 3 will be the same. How you will do? You remember step 3? First model I told you under input method. Step 3 I told you if you want to record revenue, you will write it first which revenue? Cumulative revenue. And how you will write? Contract price multiplied by percentage of completion which you got based on output now, right? That you will multiply. This will give you total revenue. From there you will deduct what? Revenue recognized in which year? In previous year. Same calculation, nothing changed. So this will give you what? Revenue for the year. What? Revenue for the year. Same way you will calculate the cost of goods sold. For cost of goods sold, how you will do, guys? Cost of goods sold, you will take cumulative cost of goods sold first. Cumulative cost of goods sold. For that you need what? Total cost, which will be given multiplied by percentage of completion. This will give you cumulative cost. From there you will deduct what? Cost of goods sold recognized in previous year. So you will get what? Cost of goods sold for the year. Understood? Again, from revenue you will deduct this cost of goods sold and you will get what? You will get the gross profit. It means it's similar to input method. Just what is the difference? Difference is here you will calculate percentage of completion based on output, not on input and output data. I will tell you. For example, another example. Let's assume I agreed with you that I will give you 100 hours teaching. In the first year, I completed 60 hours. It means 60% work is completed based on output, right? So I will calculate percentage of completion. I will take 60 hours divided by 100 hours. I will get 60%. And then I will follow the normal process. Understood? Output method is not something different. No. Output method is just we are calculating percentage of completion based on output, not based on input. Otherwise, process is the same. That is why input method and output method both are called what? Percentage of completion method. Because you are measuring the progress towards the completion based on input or output. Clear? Rest is not changed. So now, guys, I want to tell you, because as I told you, percentage completion can be calculated based on output, and output could be appraisal results achieved. Maybe I agreed with you, I will work for you for $100,000. In the first year, we agreed that, okay, $30,000 work is done. So I will take 30,000 divided by 100,000, I will get percentage of completion. Second milestone reached, it could be units produced, it could be units delivered. Any output based on that, you can calculate the percentage of completion. And here one important point. This is a very important point. And this question will be tested. They are saying that revenue may, when you apply output method, revenue may be recognized at the amount to which entity has a right to invoice the customer. Obviously, when I have a right as a seller, when I have a right, I can invoice you. When Obviously, when something is done and you agreed with that, for example, I was supposed to produce 10 units. I produced 3 units and I delivered to you. It means now I have a right to invoice for 3 units. If I don't have a right to invoice, it means you should not calculate percentage of completion based on output. This is a really important word, huh? The entity has what right to invoice the customer, and the word they used, revenue may be recognized at the amount for which you have a right to invoice the customers. Okay. And now guys, this is a small example, just you can go through. Now here I'm going to talk about which method? Zero gross margin method. Third method, zero gross margin. And I need your concentration, please. Zero gross margin. Please remember here, first of all, this method is not recommended. It is recommended only when 2 conditions are met. Then you should apply. Otherwise, priority should be input method or output method, not the zero gross margin method. This method you should apply only if these 2 conditions are met. Condition number 1 is what? Actually, in condition number 1, it is written where it is not possible to apply input method, and it is also not possible to apply output method. Why it is not possible to apply input method? Maybe cost cannot be measured reliably. Why it is not output method is why output method is not
like this.
maybe
See the way it's taking good.
Maybe we cannot measure the output also. We cannot reach to any value with the customer also. In short, when input method and output method, these 2 methods are not applicable. This is the first condition. Condition number 2 is what? Condition number 2 is what? Entity expects to recover the cost whatever they have already incurred. It's not like that I have incurred $100,000 cost. Input method, output method is also not applicable, and I know customer is defaulter, he will not pay me. It means again I cannot apply zero gross profit method. Here, what it is, it's written entity expects to recover the cost. You expect that whatever cost you have incurred, it will be recovered from the customer. When these 2 conditions are met, you can apply only which method? Zero gross margin method. Can you repeat with me? Number 1 is what? When input or output method is not applicable due to any reason, due to some limitations, and entity expects the cost, whatever they have incurred, they will recover it. If these 2 conditions are met, then you can book what? You can apply zero gross profit method. What is zero gross profit method? What it is? For example, in year one, my actual cost is 100,000. And my estimated cost, I cannot measure reliably. That's why input method is not applicable. Okay, in year 2, I'm just giving example, my actual cost is $300,000. Again, estimated cost, I cannot measure reliably. Actually, what I'm trying to say, input method or output method is not applicable. And I expect that these costs, whatever I have incurred, I will recover from the customer. So what is now zero gross profit method? That says there, you should book revenue. You should book revenue equal to the actual cost. 2 entries you can pass. For revenue, what entry you can pass? Debit, receivables, or contract asset. I'm not going into that debate when receivable will be booked. When contract asset, that I will tell you after a few minutes only. So let's assume it's receivables, debit receivables, and credit what? Revenue. And I will book equal to the actual cost. In first year, how much it is? 100,000. 100,000. And for cost of goods sold, I will also pass the entry. I will debit what? Cost of goods sold, and credit what? Cash. I'm assuming I have paid this cost. Again, equal to actual cost, which is what? 100,000. 100,000. If you are weak with the entries, so simply you can do, you will write revenue also 100,000. In income statement, you will write what? Cost also what? 100,000. So your gross profit automatically will be what? 0. This is in second year also. What you will do, you will book the revenue equal to the actual cost. Again, gross profit will be 0. And maybe in the last year, once the project will be completed, maybe one time you will book the whole gross profit. So that is why formally it is also known as completed contract method. It means here you can, in this scenario, when input output methods are not applicable, when costs we also expect it will be recovered. In first year, second year, we will book what? Revenue equal to the cost, and in the last year the whole profit will be recognized. You don't need to worry about it, you just need to remember theoretical points. By the way, I'm showing you, I have told you these entries also, okay? And on the other side, I'm going to show you on the screen, the example on the screen. Entries, it's written here also. So this is the story, we booked revenue and cost of goods sold with the actual cost data. Okay, this story just you can go through for your understanding. Otherwise, I have just explained the things. Understood? Now, guys, there's one more question is there. So let's have a look to this question. Can you read this question, please? So, guys, let me now read with you. On October 1, year 1, little company enters into a contract with customer to build a factory on the customer land for how much? $1 million. The construction of the factory is expected to be completed at the end of the 5 years. So based on Little's accounting policies, the progress towards completion of the factory is measured using which method? Input method, based on cost incurred. Okay, so far he is saying we will use input method. During year 1, Little incurred how much? 450,000 cost. This is the actual cost, right? Of year 1. In respect to the contract, and billed the customer for how much? 600,000. Actually, what the actual cost incurred how much? 450, but you billed to the customer how much? 600,000. At the end of year, Little cannot reasonably estimate the total expected cost. It means input method is no longer applicable because cost data is not reliably measured of the construction and cannot reasonably estimate the progress toward completion of the factory. They are saying input method cannot be applied. However, Little expects to recover the cost incurred. And now what is the question? What amount of revenue from this contract will be recognized in year 1 income statement? I told you when input method and output method is not applicable, when cost is expected to be recovered, so you can apply zero gross profit method. In zero gross profit method, revenue you will book equal to the cost. And what is the actual cost you have incurred in the first year? 450,000. It means revenue should be booked how much? 450,000 equal to the cost. Understood? So this is explanation you can go through. Otherwise I have told you. Okay. Now, guys, there is one more question. They can ask you about this also. See, sometime what will happen, guys? Please focus with me. Okay, I have agreed a contract with you, for example, for 2 million. Initially, I was expecting my cost will be 1.5 million. But when I started the project, I came to know, no, my cost will be 2.1 million. Now tell me, is it a loss or gain for me? Loss. It is apparent loss. Even it is not yet incurred, but it will be incurred. So whenever there is an apparent loss, whenever loss will appear, immediately you have to book the loss. And how would you know there is a loss? Obviously, when total cost exceeds what? Contract price. The loss immediately you need to book. Now look at here what's written here as a note. As soon as estimated loss, okay, on any project becomes apparent, it must be recognized in full, regardless of the method used. Even you are using input, output, gross profit, whatever, you have to book the loss immediately. Not a gross profit, you have to book gross loss in your profit and loss account. Okay, so let's assume here we have example. This is how question regarding this point will be discussed. So let me read with you and explain it to you. They are telling you each construction INC has consistently used input method based on cost incurred to recognize revenue over time. So they were using input method. During year 1, each started work on 3 million fixed price contract. It is contract price 3 million. The accounting records disclose the following data for the year ended 31st December year 1. This is the accounting data we have. What? We have cost incurred, is the actual cost, right? And estimated cost is what? 2.17 million. And this is your amount billed and collection, no need. We have to focus only what is the contract price, which is how much? 3 million. Sorry, okay. And you have to take total cost. Total cost is the summation of these two values. Actual cost and estimated cost. It is going to be 3.1 million. Right? And it means cost is exceeding by how much? 100,000. This loss should be booked immediately. How much loss you have to book? How much loss should each have recognized in year 1? It should be $100,000. This you have to book. Understood? Now all discussion about income statement presentation is completed. Now last 5-10 minutes I'm going to spend for balance sheet presentation. Okay, because you might have a sometime contract asset, sometime contract liabilities, again accounting entries I have to tell you. If you don't know, you can just memorize those entries. So here we go. I'm taking you back to the contract assets and contract liabilities. It is a balance sheet presentation I'm going to tell you. I'm not sure it will be tested in CMA or not. Very less chances are there, but being a student, you must be aware. Okay. Otherwise, question will be from income statement presentation. Clear? So here we go, guys. Actually, in balance sheet, sometime due to the contract, we might have a contract liability. What is contract liability? I will just tell you. For example, you and I entered into the contract. I have to sell chairs to you, but I will deliver in the future. You made advance payment today. You made a advance payment today. Obviously, I have received the advance payment. For me, it is going to be a liability. Until that point, until the chairs are delivered to you. Right? So this is what is called contract liability. So sometimes customers make deposits or what? Advance payments. But seller has not yet delivered the goods. So it means for seller, the advance payment will become contract liability. And sometimes we have what? Contract assets. And sometimes we have what? Receivables. Let me tell you here, guys. So when contract asset will be booked and when receivable is booked. Guys, mostly we pass this entry debit receivables or contract asset and credit what? This is debit. And credit what? Revenue. And this contract assets or receivable will arise. In which scenario? Look at me. Let me explain. Receivable, when receivable will arise? When? I'm going to tell you now. When seller has delivered the goods. Seller has delivered the goods. It means seller performance obligation is satisfied. Seller performance obligation is satisfied. And now seller is just waiting. It's just a passage of time. It's a matter of passage of time. And seller is waiting because customer has promised you that he will pay you after 2 months. So it means now we can book what? Receivables. When receivable can be booked, here is important point. The entity must have what? Unconditional right to the consideration. Unconditional right means the entity will receive this money and this is unconditional. There is no condition. I do not need to do anything further. Okay, as a seller, I have only delivered the goods. Just I am waiting for the time now. Customer will pay me. If I have an unconditional right, in that scenario, I will book what? Receivable. So when, now I'm telling you another example for contract asset and then see the difference. For example, you and I entered into the contract and I promise that I will deliver you 2 machines. One machine is delivered. One machine is delivered. And as a customer, you are saying me, okay, mister, I will give you money for the first machine once you will deliver me the second machine. It means now there's a conditional payment, right? Until unless I will not deliver you the second machine, I'm not going to book any. I cannot book the receivables now because there's a condition is attached. Whenever condition is attached, we will debit the contract asset, not the receivable. You got my point? What I said? When there is a condition is attached, seller has delivered the goods, but for payment condition is attached. Maybe seller has to deliver more goods. Condition is attached, then I will debit the contract asset. Right? If there is unconditional payment is there, because I have done all my obligations, I have delivered the goods, I'm just waiting for the payments, then I can book what? Receivable. I will show you example, don't worry. It's just I was explaining. Okay, and then guys, also remember contract assets and contract liabilities resulting from where from different contract must not be presented as net value. You have to record separate. This contract asset from this project, this contract asset from this project. Don't make as one contract asset and show one value. No. They're saying it is not recommended to net the values. Show separately. So now I'm going to tell you, you will tell me through the help of example, I'm going to show you. You will tell me there is a conditional right or unconditional right. Okay, so here we go. We have a first question. Question number 1, it's about entries. So on January 1st, don't forget the dates. Anderson Company entered into non-cancelable contract with Tanner Company for the sale of excavator for how much? 350,000. You entered into the contract that you will sell excavator for 350,000 and contract agreed on January 1. On January 1, we will not do anything. Right? We cannot book revenue, etc. Revenue will be booked once your performance obligation is satisfied. The point is only debit. Debit will go to receivables or contract asset. Okay? Then they're telling you the excavator will be delivered. It's not delivered. Will be delivered on what? April 1. Contract requires Tanner to pay how much? 350,000 in advance on February 1. Okay, what happened actually? Look, on January 1, you entered into the contract. You asked the customer he should make advance payment on February 1 and you will deliver the goods on April 1. Right? Right or wrong? And Tanner makes the payment on what? He's supposed to make on February 1, but he made on March 1. But you deliver the asset on April 1st. So guys, it means on January 1, you will not pass any entry at the time of signing the contract. Don't pass. Because you didn't receive anything. You didn't deliver anything. So what to record? Nothing. Right? But on February 1 as per contract. Okay? On which date? February 1. Because you agreed with the customer on February 1, he should make the payment. But he made the payment on March 1. It means on February 1, at least you have a right as per the contract to receive the money. But he didn't pay. It's another matter. So on February 1, what I will do, I will debit the receivables and I will credit the contract liability. Right? But he made the payment on which date? On March 1. On March 1, I will debit cash because I'm receiving cash. And credit will go to receivable. This receivable which was standing here, it will be eliminated now. Now what is remaining? Receivable is gone. Cash is recorded only. Only contract liability is pending. The day when I will deliver the machine, I will debit what? Contract liability, and I will credit the revenue. And obviously when you book the revenue, you should also pass the cost of goods sold entry also. Debit cost of goods sold, credit inventory. But here there is no cost information is available, so it is not recorded. Okay? So here there was no condition. It was unconditional payments, right? We agreed that you will make payments on February 1. But now if you look at the second example, there will be condition. So whenever there is a condition, you will not debit receivables. You will debit contract, no asset. Asset, this is my discussion. Right? Receivable is unconditional right. And contract asset is conditional right. So here we go. Let's have a look with the help of example. I take your question, guys, just wait. On January 1, Anderson Company enters into a contract with T for the sale of 2 excavators. Now there are 2. For how much? 350,000 each is the sale price of each excavator. The contract requires excavator to be delivered on February 1 and states that payment, 1 excavator will be delivered on February 1 and states that payment for the delivery of first excavator is conditional on the delivery of second excavator. It means it's a conditional right now. So the second excavator is delivered on June 1. Now guys, dates are in front of you. What I will do on February 1, once first excavator is delivered, I didn't get any payment. I will debit here now. Which asset? Contract, not receivable. Why not? Because it is conditional. Payment is conditional on the delivery of second excavator. I will debit contract. Even receivable is your asset. But I have to use what is contract asset, not a receivable. And credit what? Revenue. Why revenue for 1 excavator I booked? Because 1 excavator is delivered. 1 performance obligation is satisfied. So I can book the revenue. And if I know the cost, I will book the cost of goods sold of 1 excavator also here. I will debit cost of goods sold, credit inventory. Then what happened? On June 1, once you will deliver second excavator, so customer is going to pay you cash for how many excavator now? 2. So you are going to receive total how much? Because 350 for each multiplied by 2 is equal to what? 700. So you will debit first of all if customer didn't pay, but condition is satisfied. Condition is satisfied. So if customer didn't pay, but condition is satisfied, so you will debit the receivable by how much? Because it became now unconditional because I have delivered the second excavator also. And I am crediting what? Contract asset of how much? This 350 from where I got in the first entry I booked. And I will credit what? Revenue for 350. Why 350? Because this revenue is for second excavator. And the day when customer will make the payment, at that day you will debit cash and credit receivable and matter is over. And obviously keep in your mind, when you book the revenue, here you book the revenue of second excavator. You should book the cost of goods sold also of second excavator. Understood? Okay, guys. I hope it is clear, right? So see you in next class.